This Week in Startups is brought to you by Embroker's Startup Insurance Program helps startups secure the most important types of insurance at a lower cost and with less hassle. Save up to 20% off of traditional insurance at embroker.com/twist. And while you're there, get an extra 10% off using offer code TWIST. Brainbase. Protecting your idea should be simple. Built by founders for founders, Brainbase File is a clean and automated trademark filing platform that gives anyone the ability to protect their idea. File now for just $169 at brainbase.com/twist by using code TWIST. And Odoo is a fully customizable and fully integrated suite of business apps that lets you build and scale your stack as you build and scale your business. Your first app is free forever, and right now, Odoo is offering $1,000 off your first implementation pack at odoo.com/twist. That's odoo.com/twist.
Today, I want to cover bootstrapped startups versus funded startups. Now, we need to set some ground rules here and some basic understanding of what we're talking about. Bootstrapping comes from the term pulling one up by their own bootstraps, which is a physical impossibility, I think. Bootstraps are little straps on the back of your boots that help you put your boots on. Okay, we get it. Bootstrapping is like you can pull yourself over the fence with your bootstrap. It doesn't exactly make sense, but the term basically means you're able to create a company off of either sweat equity or revenue that you immediately start generating. So what are examples of that? A consulting business where you say, I'm willing to charge you $100 for every hour for me to be a consultant to you. Well, immediately, if you sell 10 hours a week, the company's got revenue on day one. It is really easy to bootstrap. And all it requires is, if you're going to be in one of these venture capital categories, all it requires is that you are a designer, a developer, or somehow a business, a salesperson, a marketer, one of those skills. And you kind of need to have all three of those, to be totally honest, to get most of these companies off the ground. That's why a lot of accelerators like Y Combinator or others insist on having a developer on the founding team. If it's a technology company that's high growth, how are you going to have a technology company that's high growth if you don't have a developer? You're not, in all likelihood. And if it's an outsourced development shop, that's a red flag. Why can't you get a developer on your core team? Why can't you be a developer? And so there is a bias against people who are idea people. There's a bias against marketers. There is a bias against idea people or quote unquote business people. In fact, I've heard many venture capitalists say business person means no skill, that you have no skill. That you're just an MBA with an idea. Maybe you can build a model, etc. Now, you do need to have leaders to hire everybody and bring the band together. So I don't necessarily feel that way. But I think a lot of people in Silicon Valley think in order to be successful, that management team, those co-founders at the start need to be developer, UX designer, product manager. There's a lot of different names for basically the person who architects conceptually the product manager, PM, UX, UI designer, user experience, user interface. Those are the terms that and the titles that people get excited about when they see a team. So if your team was an idea person, like I am, let's be honest, I'm kind of an idea person and a marketer, business guy. That's fine, but you need to have a collaborator. And I did. Brian Alvey was my CTO and my collaborator on Weblogs Inc. And that made me go a long way. And I had Mark Jeffrey as my CTO when I did Mahalo and then moved on to Inside. So and I was also a product guy. So having a product person, a designer, product person, sometimes those are two different skills, by the way. You can have a designer who just makes things beautiful and a UX person who works on the user interface and how the product flows. But you do need to have that in order to bootstrap, because the worst case scenario is you give money to a startup, they hire an outsourced dev firm. The dev firm says, okay, you stop paying us this month. You've been paying us for 10 months. The product's out. And then the product doesn't work. There's no developers to work on it. And the company goes backwards. So one other caveat here is something called friends and family money. Friends and family money is when you are not qualified to get venture capital. and you go to your friends and your family, your associates, maybe people you've worked with, and say, hey, I'm passing the hat. I'm trying to raise money. And then I'm going to take that money. I'm going to hire people. And maybe you can, with that friends and family money, kickstart the project to get enough traction to get into an accelerator or to get venture capital. Pretty hard to do. Not everybody's got the rich uncle or rich aunt who are willing to throw $100,000 or $250,000 at a project, but some people do. Some people will keep their day job. There's another bootstrapping technique. Keep your day job and build on the weekends and nights. Or go to your boss and say, hey, I'm willing to stay on for 2 days a week, and I would like this consulting fee. And then the other 3 days a week, you work on your startup, or 3 days at your current company, 2 days on your startup. A lot of people will start the flywheel going that way, do their user interviews, understand customers, do their research, build their MVP. You want to have your landing ready before you take off, is basically how I would describe this. So if you're going to take off and go out over the ocean, you better have the landing in mind, and you better have enough fuel. Fuel in this case would be your personal runway. Personal runway would be, okay, you've got $5,000 a month in bills and payments and rent and whatever. Okay, it's going to take you 18 months to build this company out to the point at which you get venture capital. Do you personally have 18 times 5? Do you have $100,000, $90,000, $100,000, $110,000 with a buffer in your bank account to keep you solvent while you spend 1.5 years of your life trying to get this startup off the ground? And I did that. A lot of my startups, I was working as a consultant, or I had a little bit of cash from the previous project in my bank account, or I went into debt, which is very dangerous, and not for everybody. But there is risk. You're not entitled to be a startup founder or get venture capital. You must understand this when you come to the table and decide you want to work in this space. So we talked a little bit about bootstrapping versus VC. If you bootstrap, the longer you bootstrap, then the less dilution you will have to your cap table. So let's pause on that for a second. If you raise money from that friends and family round and you raise $250K, you might get a $2.5 million valuation. You've given away 10% of your company for that $250. Now, if you find a co-founder who's a developer and you're a designer UX person, you don't need the $250 because you're not going to give it to an outside firm. So the two of you just build it on the weekends or nights. Now you have no dilution. Now you get the product to a prototype phase and you go to a seed fund or an accelerator and you raise $100K for 6% of your company at an accelerator, or you get a seed fund to put $250K, $500K in, let's say, at a $5 million valuation. Well, now you got the product done, and you got $500K and you diluted 10%, as opposed to in the previous scenario, you would have spent the $250, gotten the product to launch, and then taken another $500K from a seed fund and diluted another 10%. In other words, you would have given away over 20% of your business. You would have less than 80%, and you would have raised $750. The longer you can push out the funding and the more you can accomplish with less, the less funding you have to do. We call this a pegasus, or I came up with the term pegasus. So there's unicorns, companies worth over $1 billion. But a pegasus for me is a company that flies over through the wings of bootstrapping. They fly over funding rounds and they skip funding rounds. And I encourage you to think about, how can I grow this business so strong that I can skip my next round of funding? It's very out of favor right now. Everybody loves to raise funding. It's such a hot market in 2021. Valuations are high. Why wouldn't you take money off the table? That's true. And that is a true statement. Money is sloshing around everywhere. People are raising money at very high valuations. I don't blame them for doing that. A lot of advice is situational, right? So I'm giving you this advice based on a certain situation, which would be a normal market. In a hot market, yeah, if you can raise money at a high price, in the same example I just gave, if you were raising that first $250 at a $10 million valuation, it's only 2.5% dilution. Who cares, right? So that would be a de minimis amount of dilution. You can go for it. But some companies like Webflow, Bubble, Calm.com, Notion have skipped rounds of funding. And we were involved in Calm.com and we watched them skip 2 rounds of funding, 3 rounds of funding. And that meant our percentage ownership, along with the founders, was very high because we didn't dilute. And then as the company became worth more and more, we didn't have to put up a bunch of pro rata. We didn't have to keep investing to keep our percentage ownership. And that was amazing for everybody. Every startup needs business insurance, and you should look no further than Embroker. If you don't have insurance, you failed one of the first steps. Embroker technology saves you time and money. Prices are up to 20% lower with better coverage than the incumbents. You can go from sign up to quote and purchase in just 10 minutes. When you work with Embroker instead of business insurance incumbents, you're not dealing with large, slow corporations. Plus, the sign-up takes days, not weeks, and the process is transparent with no opaque pricing. Here are 4 crucial types of startup insurance that they cover. And you're going to need all 4 of these in all likelihood. Cyber insurance, in case you get hacked. D&O insurance, so if your directors and officers do something dumb and you get sued, you're covered. You have E&O insurance, which covers errors and omissions. That's what the E and the O stands for. And it helps you scale because many major customers will ask to see your E&O insurance in order to close a deal. And of course, EPL, Employment Practices Liability. This covers harassment, wrongful termination, and more. To instantly buy custom-built insurance for startups, go to embroker.com/twist. That's embroker.com/twist. And while you're there, get an extra 10% off using the offer code TWIST. You guessed it. Okay, let's get back to this amazing episode. So you can still bootstrap after you're funded. You can skip rounds of funding and be a pegasus, and that's amazing. So at a certain point, you can bootstrap and then qualify for funding. So what are the signals that people will see in there? What are the signals, do you think, that will get an investor excited about a bootstrap company? Very simple. If you have built a modest team of people who are really motivated and who are operating at a high level. We love looking at the team members and who's running the company. So you built a team of 3 people. You got enough revenue to make $30,000 a month. You are giving that $30,000 or chopping it up $7,500 each with your 3 first employees or your co-founder and 2 first employees, whatever it is. In the mix, you got 4 people. You got to $30,000 in revenue and you haven't raised any money. Do you realize how attractive that is to an investor? You're able to hire your first 2 employees without raising money off of your own revenue. And that's where this art of bootstrapping and getting a couple of customers into your product early and paying you, which is completely possible for a SaaS product or a software product. Marketplace is a little bit harder, but still possible. You can bootstrap a marketplace, i.e. you could create Airbnb and just source 20 high-end castles, and beautiful, unique homes in Spain and make the Airbnb of Spain and then just book with people want to book in Spain and manage those and take the profit from them. That would be a perfect way to bootstrap Airbnb. And in fact, I think they did that. They were using their own couch as the test of it when they started. So you can get a team together that builds credibility. Building the product and finishing the product, that builds credibility. Third, having a customer who will not shut up about you and pays you either in time and effort or with money, hopefully both. If they're using your product and they're paying for it, oh my Lord, checkbox, checkbox, checkbox. Great team, great product, and really delighted customers. Now you're ready to get funding. But so many people who are coming to Silicon Valley or coming to the tech industry think it's about a business plan. They think it's about networking. They think it's about who you know, not what you know. It's not about who you know or what you know. It's about what you've built. It's not about who you know. It's not about what you know. We don't care who you know. We don't care what you know here in Silicon Valley. We care about what you've built. What have you built? The team, the customer base, and the product are all things you manifested in the world. You built. And people have concerns about Silicon Valley. Is it a meritocracy? Is it fair? Oh my God, representation isn't great. There's bias. Of course there is. There's bias everywhere. There are problems with representation in all different markets. But when you look at Silicon Valley, one of the things people don't understand is that if you are capable of building a product and a team and getting customers, if you can build any of those 3, 2 of the 3, or even 1 of the 3, you are going to get meetings. If you can build a great product, build a great team, or get customers, any combination of those, you will go from being a bootstrapped company to a company that's a fundable company. Don't waste your time on the deck. Don't waste your time on the pitch. Don't waste your time on networking until you have a great MVP, minimum viable product, a prototype. Don't waste your time on trying to get meetings and coffee meetings with people until you've got a member or two of your team. And don't try to get the meeting with all the partners until you have a couple of customers. These meetings will take up all your time. Trying to get them will burn all your time. And you could have put that into bootstrapping and actually building the MVP of your product. Now, if your product is not bootstrappable, like you want to build a car company, well, you might need to start with a business before building a car company, because if you have no credibility, you have no track record, you don't get to be trusted with the $50 million it might take to get a car out the door, or the $150 million it takes to do drug discovery or get a medical device out there. You might need to work on a software business before that, or you might need to work for somebody else's car company or somebody else's biotech company. So again, about this being fair, if you're a nobody with no track record, put yourself in the capital allocator's shoes. Would you give them $10 million or $100 million? I hope not. I hope you wouldn't do that. That would not be wise. You need to have people who have experience, who've done it before, if you want to do those big, big projects. And if you think about it, Tesla, Elon funded with his own money that he made building a software company, Zip2. So you should know the history of these things. It's really hard to do the hardware projects. Direct to consumer or consumer packaged goods, when you look at those, they tend to not have high margins unless they're direct to consumers. And they are easy to 2x or 10x those businesses, but can you 100x them? They're a little bit harder. So you don't see too many businesses in direct-to-consumer or consumer packaged goods getting funding from venture capitalists. We had a little bit of a direct-to-consumer boom, for sure, with Casper, 8 Sleep, and other companies, but it's really hard. The product needs to be super differentiated. It has to be a very unique product, like the Peloton, maybe, or the 8 Sleep bed. Any of those kind of direct-to-consumer hardware businesses, physical products, they are really hard to make work. Tonal, it's just really expensive, and you have to install it. That's why they have to charge subscription fees. So some businesses are just not easy to do. And now there's crowdfunding. Just a little exception here that's worth noting. Some people will, if they're building a hardware product, be able to put it on Kickstarter, be able to put it on Indiegogo and get the flywheel going with people ordering in advance because it's such a visionary company. The only thing I'll say is many of those projects fail because they undercharge. They think they should charge the people who are the early adopters less, when in fact they should charge them more. They should charge them extra for letting them be part of the excitement of building a new product, not charge them less and then underprice themselves and get into debt and not be able to deliver the product. So bootstrapping means you have to have some skills. If you don't have skills, well, you know how to get them. Just go to YouTube, take a UX class, take a no-code class, learn how to use the no-code platforms out there, Webflow, Bubble. There's a ton of them out there. You can start building your own MVPs in no code. Now, this doesn't work for every company. You think about a drug discovery company. Somebody's trying to find the cure for cancer or a medical device, or they're doing some deep tech or building rocket ships. Some things are massively capital intensive. Now, bootstrapping versus fundraising, and at what point bootstrapping companies can then become funded. Now, it's important for you to understand that venture capital is not a right. Everybody doesn't get to raise venture capital. Venture capital funds a very small percentage of businesses in the world. And venture capital is impatient capital. Venture capital is looking for unrealistic growth. Some might even argue unnatural growth. Growth in the 20% a month range. If you're growing 20% a month, that means your business is doubling every 3 or 4 months. Where do you find businesses that grow this fast? Well, you only find them in the early stages, and you only find them in truly breakout companies. So why does venture capital even exist? Well, it exists because every 20, 30, 40 companies in Silicon Valley, some company actually achieves this unrealistic goal, and they pay for all the other mistakes, and I'm using air quotes in here, or failed experiments in a portfolio. So that's the dynamic of how venture capitalists look at it. Venture capital is not the only source of fundraising in the world. So take a pause and understand. Number one, you do not get to have a right to venture capital. You have no right to get venture capital. It is a competition. And the people who judge this competition are capital allocators known as venture capitalists who have to find those big winners in order to keep their jobs. That's the crazy, insane Silicon Valley methodology. I have no idea why this exists or exactly how we got here. I'll be totally honest, but it exists in the world. It is a very strange part of capitalism that this crazy venture capital even exists in the world as a category. We used to have bank loans. Maybe people raised friends and family, but or somebody had a rich uncle or an aunt or got an inheritance, and that's how businesses were built, or people inherited businesses or inherited wealth. And now you have this weird practice of venture capital. Now, many founders ask me to invest in their company when they have an idea. We don't do that. Why don't we do that? We don't have to. There's so many people out there who've bootstrapped their company and come to us with $10,000 a month in revenue, or $1,000 a month in revenue, or $50,000 a month in revenue. And they have a couple of customers and they have a product that we can use and look at the how well it was built. And we can look at the customers. We can look at the growth. We can look at the churn rate, how customers leave the product, how they acquire customers. So you, as a founder, are in a competition. So let that sink in. This is not socialism. It's not communism. Everybody doesn't get a loaf of bread or, a certain percentage of venture capital. It is a dogged competition. It is a crazy competition. It's an unfair competition. Just accept that as the table stakes. And then you will be free to understand how you can qualify and how you can actually win that competition. Once you have that realization that it is unfair, that it is a dogged, crazy fight to get that venture capital money, then you will be free to start thinking about what are the precursors to getting venture capital, and maybe even do you want it? Because venture capital is jet fuel. You put jet fuel on a skateboard or a bicycle or a car, it's just going to explode into a fiery mess and everybody dies. Jet fuel is for rocket ships. And you have to ask yourself, is this business in fact a rocket ship, or is it a slow growth or a normal growth business? Remember, venture capital, impatient capital. Realistic growth is not what they're looking for. Venture capital is looking for unrealistic and perhaps even unhealthy growth. Growth that is going so crazy and so fast that maybe, the tires come flying off or things are messy, mistakes are made, but growth at all costs is really what venture capital is about. Now, people will argue that there's conscientious capital or people are looking for you to grow slow and steady wins the race. People might say that, but I think it's platitudes. I think in reality, venture capitalists want absurdly high growth companies in the double-digit percentage month over month. And most businesses probably grow double digits year over year. So this is a whole different pace. This is like sprinting versus jogging, right? Or walking. It's totally different. How much time and money do you spend integrating a bunch of different software products together at your company? Let me guess, way too much time. Well, Odoo is here to help. Odoo is a suite of business apps that runs your entire company on one platform. They'll streamline your workflow by bringing all of that information together. Plus, Odoo's integrations eliminate repetitive tasks and data entry. If you only need 2 or 3 apps to optimize your workflow, that's all you pay for. Odoo won't stick you with the bill for apps you don't use. Odoo has an app for every business need. They offer 30 main apps that are updated regularly and over 16,000 apps from their active open source community. You can keep your books tight with their financial software, and their sales and CRM apps will help provide a clear and organized view of your business. So here is your call to action. Your first app is free forever. And right now, Odoo is offering a $1,000 credit on your first implementation pack. That's not a joke. That's $1,000. Just go to odoo.com/twist to check it out. That's odoo.com/twist. What type of businesses should seek venture capital? Well, if you're looking at venture capital, it's very few companies really get those. And, very few companies qualify for venture capital. And that's why many times people will say, hey, your bootstrap business is a lifestyle business. This is not a negative term, although it's perceived as a negative term. When people say, hey, I think you're just a lifestyle business, that word you're just a lifestyle business, is a little derogatory. But what we mean in our industry when we throw around the term lifestyle business is this is going to be a great lifestyle for you, the founder and owner of the company. But it's not going to provide returns for venture capital firms that would please their LPs who are big endowments or retirement funds or high net worth individuals. It's a lifestyle for you. You might make $1 million a year from this lifestyle business. You might make $10 million a year from this lifestyle business and rock on. That's unbelievable. And if you have a business that's throwing off $1 million in free cash flow a year and you're pocketing that every year and every year it's growing 20%, well, the best thing for you to do might be actually to pocket the $1 million. 10 years from now, it's growing at 20% a year. That means it's doubling, every 4 or 5 years, 3 or 4 years, you're probably doubling. And if you're doubling every 3 or 4 years, then maybe you're taking out $2 million after 4 years. And then after another couple of years, you're taking out $4 million. You get the idea. And you still own 100% of the business. Why would you ever sell it? But it's not fast growth, so it's not going to IPO or get bought by one of the bigger companies, which is typically how venture capitalists get their money out. They buy in, they have an IPO, they buy in Microsoft, Google, Facebook, whoever buys the company. Those are the two big outcomes for venture capitalists. So lifestyle businesses, which means businesses that are growing single digits per month, not double digits per month, and that are growing less than 2 or 3x year over year, that's a lifestyle business in the minds of venture capitalists. They're not going to fund a lifestyle business because it doesn't have venture scale. Venture scale, another term that we use in the industry. What does venture scale really mean? Venture scale means that this business can get to, in 2021 terms, $100 million a year in revenue, $250 million a year in revenue. You start thinking about those numbers, $1 million, $100 million a year in revenue is $250,000, $350,000 a day in revenue, $10,000 an hour. It is possible to build these businesses. It's just hard to build them. And so why do they need to have businesses that can reach that level of scale? Well, those are the businesses that start to get the attention of the big companies to buy them. A lot of big companies, they're not interested in buying any company with under 500 million or $1 billion in revenue. Take Microsoft or take Google. When you're printing up as much money as they are, to move the needle on an acquisition is very hard. You need to have a business that really is making some large amount of revenue and that can grow from that point forward, hopefully with that mothership's, reach and dexterity and expertise. That's for an acquisition. And then for an IPO, well, the public markets are not going to care about a company with 50 million in revenue, generally speaking. They're going to want companies that have hundreds of millions of dollars in revenue, if not billions of dollars in revenue, as we've seen over the last couple of years when we've had a boom in SPACs and IPOs. And the SPACs do bring the benchmark down a little bit. You could have companies that are pre-revenue go public, et cetera. So venture scale businesses, it just means you're going to grow 3, 4, 5x year over year, 10, 20, 30, 40% month over month at certain points in times in the business. And you're going to get to 100 to 250 million a year in business, which means the investor has a chance to turn $1 into $100. Not 100% growth, which would be doubling your money. We're not talking about percentages here. We're talking about X. $1 goes 100x, 100 times. $1 turns into 100. That's kind of what venture capital is looking for. So you have to ask yourself, does my business really qualify for this insane race? Is it an outlying company? Is it a software company? Great. Software companies can grow that fast. Why can software companies grow that fast? The reason a software company can grow that fast is because there's no cost of goods. You write the software once. I write the game Angry Birds. And if 10 people play Angry Birds and they pay $1 each, I make $10. If 10 million do it and I charge them $1, I make $10 million. The cost of Angry Birds remains the same. The 5 developers who developed it. Instagram, maybe they had a dozen people working on that when they sold it for $1 billion. And you really don't need more than that. Building a world-class app today, even on iOS, is a dozen people for Android and iOS. Like literally 12 people can build a world-class app. So you have to ask yourself, is it a software business or a marketplace? What's a marketplace? eBay, Airbnb, Uber. These were all marketplaces. One side puts up supply. Another side is the demand. I'm demanding. I need a place to stay when I'm in Paris. And you're the supply. I have an extra flat in Paris that I can rent you for €300 a night. That's a marketplace. Marketplaces scale because as the number of participants increase and the frequency of transactions increase, oh my Lord, the 5 or 10 or 20% of each transaction they get can add up pretty quick. Uber Eats, DoorDash, also marketplaces between drivers, restaurants, and consumers. So it's really like a 3-sided marketplace when you think about it. Those are the type of businesses that investors typically want to invest in because we've seen over and over again, they're high margin and they're high scale. High margin, they don't have a high cost of goods. High scale, because, the 100th person coming in doesn't require any handholding. The 10,000th user of, a marketplace like DoorDash or Airbnb doesn't cost you anything to onboard them, and neither does the millionth or the 10 millionth. They just can come in and use the marketplace because it's already set up there and it's vibrant, and they get to just jump in and benefit from all that velocity in the marketplace. So those are examples of very high scale business. What's a business that's not high scale and low margin? Selling Ethernet cables, selling chargers for your phone. It's a race to the bottom. It's hardware. Anybody can make it. You don't have any IP. Nobody cares about the brand. I mean, I might care about Anchor. I love that brand, but most people don't care. So hardware is hard, and it tends to not have any reoccurring revenue. You sell it once, you're done. One transaction at low margin. Services business, consulting businesses. Consulting businesses, your cost of goods is how little you can pay somebody, and your top line revenue is how much you can charge for that person, and you just live in that tight little margin between we're charging $200 an hour for this developer and we're paying them $125 and we get that $75, and everybody hates you because the developer wants to make more money, the customer wants to pay less, and your margin's constantly getting crushed. It doesn't scale gracefully. It's a waste of time in most people's minds. And that's why SaaS, software as a service, cloud computing, consumer subscriptions, all of these things are software-based businesses that scale very gracefully. When you are going into venture capital, you also are going to, in all likelihood, be giving away a large swath of your company. Think 10 to 20% of your company 3, 4, 5 times in the life of the company, which means typically 2 founders will get down to 10% each in ownership of their startup by the time there's an exit. And if it's a single founder, maybe they have 15 to 25% ownership, but you're going to get diluted massively, and you will often lose control of your company in that you have taken on 3 or 4 venture firms, 3 or 4, 10, $1 million to $25 million checks over a 5 or 6 year period. They are on the board. They can oust the founder. Sometimes founders have protection and provisions in there, but other times they can be ousted and removed from their own company. Doesn't happen as much these days, but you get the idea. So keep this in mind when you're building a business, that if you do go the venture route, you're going to go really fast. You're going to give away a lot of your company. And it's going to be with a high risk of failure because venture capitalists only care about outlier success. If you're going to be an average success, they're really not interested. So they're going to disengage from your business. They're not going to want to be involved in it if you only grow at 50% year over year. They're only going to be interested, and they're only going to get excited when you're doubling and tripling revenue year over year consistently. So why would you do that? Well, the reason you do it is because you could have an outlier success. That's why people sign up for it, is they might have the chance to be an outlier success. Why would somebody opt out of it? Well, because the chances of success are like 1 in 10 or 1 in 20 or 2 in 15. Who knows? It's a very small chance of success, but if you do win, you get outlier success. And most people, candidly, don't understand what venture capital is. They think that everybody's entitled to it. They don't understand how competitive it is, and they don't understand how narrow the lens of businesses are that are venture fundable in the current model. Other people have tried to make slower growth models where they do slow growth companies. And just as a little bit of an aside, you're really not trying to build a business with the acquisition in mind. Going in saying, I think we could sell this company to Microsoft in 5 years for $50 million. That's not what venture capitalists are looking for. So keep that in mind. They want the outlier success. It turns out venture capitalists and venture capital firms are typically defined by 1 success, maybe 2, each fund. And that means a venture capitalist over the course of their career, they might be involved in 5, 6 funds. If they're involved in 5 funds and there's 1 or 2 hits each fund, there might be a dozen hits over those 5 funds, maybe 10. Of those 10, the top 2 or 3 will be the majority of the returns. The top 10 will be 95% of the returns. And that means each partner might work on 1 of those. So in other words, a career in Silicon Valley, a venture capital career, is made with 1 outlier investment over a decade or 2 of working in venture capital. Sometimes you get people who hit 2 or 3. I've hit 3 or 4 really big ones, and they kind of define your career. Robinhood, Calm, Uber, these things are career defining. I've gotten very lucky to hit, 3+ in a decade. There'll be more, down the road, but these this is the nature of the other person on the side of the table who might fund your startup, is that they are going to place 20, 30 bets in their career, and one is going to define their career. And the one that does is the crazy outlier, This is, but 5% of funding of companies or less is from venture capital. It's a very small mix of the investment in companies. So again, if you're going to do this, you really want to be doing it in a growing market, and you're going to want to have to go fast, and you're going to want to have other people involved. If you don't want other people involved, if you don't want to be collaborative with investors and hear their opinion, if you are not swinging for the fences and trying to grow really fast, don't take venture capital. Don't even consider it. You can just have a bootstrap company, get to profitability, and just sweep the cash off every year, make it an LLC instead of a corporation with shares, and just focus on distributions year after year. So building to sell is really a dangerous idea. You don't want to do that. You're building to build a large, sustainable enterprise. And the second option is you sold to somebody. Now, bootstrapping versus funded companies. I hope that this candid advice is helpful for you as you start your journey. Remember, you got to have great skills. You got to be able to build these products yourself. You've got to be able to build a team, and you got to be able to have great customers. Product, team, customers. Product, team, customers. Those are the three pillars of building great companies. The market is out there for so many products, and all you need to do is build a great team and build a great product and put it in front of customers and let the magic happen. It's that easy, folks. No, it's really hard, but you have to have skills. If you have no skills, ask yourself, what? Am I ready to be a founder? Maybe I should get some skills. You might get lucky and just be an idea person who could manifest a bunch of investment and talk people into it. I've seen it happen. It's just happening less and less these days. The people who are getting funded more often than not are able to build their prototypes, MVP, and get something in front of investors with $0, with only sweat equity as bootstrappers. And those are the best, most fundable founders, according to what VCs say around the poker table or when they're having dinner or they're being candid with each other. Oh, that person can bootstrap a company and get a couple of customers. They're capital efficient. That's who I want to place my bet on. The person who actually knows how to build great products and teams. So keep that in mind. And I hope this has been helpful. Okay. Every startup needs to ensure they own their intellectual property, or IP for short, and that starts with filing your trademark. I have been filing trademarks for 30 years, and I know what I'm talking about. It's one of those things that people forget to do or they put at the bottom of their list, and I understand that. It's a pain in the neck, but it is not a pain in the neck anymore. If you don't know where to start, look no further than Brainbase File. It's a clean, simple, and automated trademark filing platform that gives anybody the ability to protect their best ideas. There is no need to spend thousands of dollars on lawyers to file your trademark for you. No, now you can do everything yourself in just a few easy steps. Brainbase File gives you goods and services recommendations using AI, so you can avoid the back and forth with the U.S. Patent and Trademark Office, USPTO, and you can eliminate human error. They also offer full transparency into the USPTO process with step-by-step notifications and real-time updates on your trademark's approval. This is a process, folks, so save a ton of money. Just head to brainbase.com/twist and enter the code TWIST at checkout to file your first trademark now for just $169. That's a 15% discount. That's right, brainbase.com/twist and enter the code TWIST at checkout to file your first trademark now for just $169. Okay, Zach Coelius is with us again. How are you doing, Zach?
Every day, just try to suck a little less. I'm trying.
There is a goal. Every day, trying to just not suck. It's humbling.
Less. I still suck a lot. Yeah. I just want to suck less.
Or you could say you want to incrementally get better.
Yeah.
But it's two ways of saying the same thing. It is humbling what we do as investors because we are constantly faced with making decisions and not knowing if we made the right decision for somewhere between 5 and 10 years. How have you reconciled this, challenge to keeping a scoreboard?
Yeah. Well, I mean, my default is I just assume I'm an idiot. So that just it goes with the territory.
Yeah.
But, I really think about it in terms of like the day-to-day tactical execution of the businesses that I'm involved with. And it's, I try to be in there figuring out what's going on and trying to be helpful and watching. And if they're moving the ball forward, I'm super happy, because at the end of the day, this business is a business where you can get incredible rocket ship growth in really unexpected ways at unexpected times. And as long as you're on the field and you're moving things forward, you're in a position to be ready to catch that. Like, so for instance, today they announced that Cotu put 120 million into one of the businesses I've invested in, Mercury.
Mercury, that's the bank, right?
The bank, yeah, it's like $1.5 billion business now. And
congratulations.
When they first started that, oh man, it was not easy. And I mean, watching them, building a bank, like, not easy.
Wait, I'm shocked. Starting a bank is not easy.
Yes,
but
yes.
I just summarize your 2 points, I think. If you think about what we do as our day jobs and what founders do, you cannot absolutely guarantee any outcome. You have very little control over the outcome, but what you do have a lot of control over is what you do today, your process.
Yeah.
And the process of being an entrepreneur, from what I'm hearing from you, is to be on the field and to keep improving and to be of action, to be getting stuff done so that if you do catch lightning in a bottle, if you do happen to catch that wave, man, you can have a great surf, you can have a great ride, and just be ready for that. As an investor, we just have to be as helpful as we can and meet as many great founders as we can. That is the process, is it not?
Yeah. I mean, for me in my day job, I think about it like, am I helping my companies, adding value so that they let me keep investing in their businesses as they grow? And am I talking to new folks and being helpful to them, helping them see around corners and helping them meet other great investors or meet customers or partners so that when the time comes that they raise money, they let me join? It's, for me, it's like the more value that I add in a leveraged way in the ecosystem, the more goodness comes back. And that's every day that I can do something useful to the ecosystem, whether it's my existing companies or companies that I'm involved with or companies that I just I'm excited about, I feel like I'm moving the ball forward and I'm happy.
Or being here on Ask Jason and Zach, or reoccurring, answering of questions and commiserating over how absolutely we have imposter syndrome every day. I mean, when you think about it, you work really hard as an entrepreneur. You and I both got our asses kicked and kicked a little ass as entrepreneurs. And then you get lucky enough to be a capital allocator where you get to, pick who gets money to pursue their dreams. It's pretty humbling and it's super random. I too today had a great day. Robinhood went public.
Yeah. Woohoo! That's awesome.
Crazy. Yeah. I mean, it's the third biggest win of my career after Uber and Calm, which are now tied, actually.
Oh, wow.
Well, we owned just basis points in Uber, but we owned 5 or 6% of Calm.
Nice.
So that shows you when you own 5% of something worth 2 or 3 billion, and you own 10 basis points or 20 basis points of whatever of something that's, 100 billion, you can have slightly similar outcomes. And owning a larger percent now is part of my goal. What is the average check size, just as we start the show off here before we get into the questions? Average check size for you today, how many deals are you doing a month, a quarter, a year, whatever number you want to pick? Yeah.
So check size is growing. I've got a new fund and it's bigger. But average check now is probably in the sort of 500 to million range for early stage. And that's growing. So it'll probably be a little bit bigger in the next 6 months. And I try to do in a given year, 5 or 6 new companies. And then I'll try to find, and then I'll invest in my existing businesses. So a good year, I deploy maybe $15 to $20 million if I'm doing my job correctly, and things are
as
things
a
are right.
Solo GP.
Yes, as a solo GP, I'm
like me. Yeah, you and I are the same. Both solo GPs with teams around us. You have a team built out yet?
No. I have team. I don't even have an assistant. Whereas you have this squad of Uber assassins on your side.
I do have a squad. Yes. Well, the advertising on the show has helped me build a team. It's literally the truth. For the last couple of years, the profits from This Week in Startups pay for the investment team. Although we now have with the new fund, we have a little bit more for the first time, some fees to hire some folks. So we're getting there slowly. Cool. All right, let's get into these questions here. First question via emails from Francis. He asks, what is your number one piece of advice for newer angel investors? I'm part of the syndicate and would love to up my game. Okay, we got a new angel investor, fresh in the game. What's your best advice there, Zach, in 2021 for a new investor?
Yeah, I always say take your time and plan on this being a really long game, both in terms of the outcomes, but also in terms of the deployment. Like if I look back over the last 5 years, I've written about 80 checks, and the first check I wrote, I was in a very different place in terms of my capabilities and my education and my experience. And if I had, blown my wad early and wrote a bunch of checks at the beginning and then hoped they would all work, I think I'd be happy because that year ended up being a great year for me, but I wouldn't be in as good a place as I am now. So just expect it to take a long time, and then you're going to have to write a lot of checks.
I always like to use the analogy of learning poker. You would not want to sit down at a high stakes game when you don't know which is a better hand, a flush or a straight. And literally when I started playing poker, I was in games where people are like, I win, I got a straight. And the person's like, well, I got a flush. And he's like, well, a straight's better than the flush. And people didn't even know. Like literally somebody at the table had to keep a card of the winning hands. Like what was, it's three of a kind's better than two pair. Yeah. Okay, great.
I want to play in that game. That sounds awesome.
It was pretty funny. This is literally, but it was a $20 buy-in game. I think they were playing 25 cents, 50 cents a game. So like people would bring rolls of quarters to the game. It was quite fun. And so I do think you want to take your time. And in terms of thinking long-term, you are playing a long game, and you're playing a reputation game, and you're also playing a long game against the cycles. So here we are in a tech super cycle that started in 2009, which is exactly when I started investing. And you started investing similar time frame, right?
In 2015.
2015. Okay, you came 5 years after me. So you started investing halfway into the super cycle, or maybe a third of the way in. Mm-hmm. And so it was starting to climb up. When I started, it was on the floor. I mean, I couldn't get but 5 or 6 angel investors to show up to meet 4 or 5 companies at Open Angel Forum. And at that time, Angel List was called Venture Hacks. And it was an email newsletter. There was no Angel List. There were no syndicates. It was just people shooting emails around, which actually you did as well. So take your time making those first couple of bets. There's no rush, and don't feel pressure. Be disciplined. The other thing I'll say is, maybe the first 10 bets you make could be in companies with products in market and some traction, so that you're not making these bets before the product's even launched. You can actually use the product. Okay. We got a live question from Gatsby. No indication if he's great or not. The question is, what are typical mistakes you see founders make in their first meeting with you they should avoid? Okay. This is a great question. What are silly, stupid things that founders do, or you've seen that are just a mistake when you're meeting with investors?
I mean, the number one is lying. Like, a lot of these founders are they really want to get the deal done, and they feel pressure to basically put their best foot forward. And it's pretty easy to sort of stretch from exaggerating to lying. And, when you're on the other side of the table and you just watch these folks all day long come to the door, you get a really good pattern recognition of when they're lying. And, there's a lot of ways to trip somebody up. And I mean, I'm constantly basically trying to figure out, are they really a truthful person? Because that's one of the biggest things that is like a red flag for me, is people that I can trust when times are bad and things are not working right, to be truthful and honest and open and transparent about what's going on. Because otherwise, it's really hard to work with people. And that's the biggest one. And I see it over and over and over again. And it makes me sad, because it's like, there's these great entrepreneurs who I would love to invest in, but they're just liars. And I'm like, I can't do this.
And there's lying, and then there's stretching the truth. There's exaggerating. There's a whole spectrum here. And I think what's important in what you're saying is, as an investor, we know imposter syndrome. We know that you don't think you're adequate. We know that you're concerned you only have 3 paying customers, and one of them doesn't actually use the product, and the other one's your friend from college, and you really, at the end of the day, only have 1 paying customer. And we are okay with that, because we've invested in companies over and over again and watched this collection of ragtag, misfits, and pirates create something of massive value from nothing. We understand that. So there is no actual need to exaggerate to us. And you're so correct, because it always comes out. I always find it out because I do math in my head and I say, how many customers you have? They say 100. I say, what does the product cost? And they say, it costs $100 a month. And I go, 100 times 100, you get 10,000 in revenue a month. And they say, I say, oh, so you're doing 10,000 in revenue? And they said, well, no, not exactly. I'm saying, well, what are you doing in revenue right now?
Yeah.
And it's like, oh, we're doing $0. And I'm like, you have no revenue. You just said you have 100 customers. Like, oh, well, that we plan on charging 100. Those 100 people are in beta, and they're not paying. And I'm like, okay, great. So you have users in an unpaid trial. Great. If you had presented it as users in an unpaid trial, I'd be like, oh, that's great. Tell me about the top 10. How are they using the product? Whatever your traction is, however modest it is, it's something, and it's better than lying. Okay, next question. And this is from the dude. And so when the dude has a question, it's going to be a good one. It's coming in hot. What do you think about white labeling tech to help build or finance your core product? It's a great question. Coming in hot, dude. What do you got, Zach?
I mean, I always say that anything you can do to get to sort of, like Sarah Tabel has a great saying where she's like the red hot center of your business, and whatever you can do to like make the other parts easier and faster to get to that spot, the better. And so white labeling technology, whatever you have to do, totally fine. Now, at the end of the day, you still have to basically be able to tell a compelling story about how you really are a technology business, and how there is a moat around your technology, and how your technology enables you to grow really rapidly, and you won't become commodified. So if you're using the same technology that everybody else has access to, that's going to be challenging when it comes time for competition to show up, and they're always going to show up. And if you don't have the ability to protect yourself, investors are going to look at you very differently than if you've, built your own proprietary stuff. But getting to that sort of core proof point to validate the idea, the business, and the value that you deliver to a customer, and then building out from there is a great idea.
Yeah. And by the way, Sarah Tavel, general partner over at Benchmark, was on Angels Season 4, Episode 4 back in February. Great guest.
She's awesome.
She's pretty great. I think it was one of my final guests in the studio before COVID started. Wow, that's crazy to think about. If you're doing white labeling as well, and you sort of mentioned here, sorry, I didn't mean to be casual there with you, dude. Mr. Dude. It's a great way for you to keep the lights on. And some people are very precious about like, just raise money and stay focused, But the truth is, you may not be able to clear market with investors. You may be an outsider or whatever. If you get 3 people to take a white label version of your product, and you own all the code, and they're giving you $5,000 a month each or $15,000 a year each, and that keeps the lights on, great. Keep the lights on, and then you can launch the web-based product that is not white label for everybody else based on what you learned on their nickel. I'm not precious about it. Whatever it takes to get to product market fit, to get that burning ember at the core of your product, not a problem. Now, if you do have a consumer-based product and you're like, should I have a white label and a consumer? Those are kind of two businesses.
Yeah.
It's kind of hard to run both in the same company, isn't it, Zach?
Yeah, absolutely. That's another, to go back to the first question we had, it's like, what's a red flag? Whenever you have 2 different things going on that have different focuses and different like areas of attention that are required, and you have to make different decisions for those 2 things, it's a huge red flag for me. Like, because at the end of the day, when you actually find product market fit, what happens is that the things that used to be really hard, revenue, customers, traction, actually becomes really easy, because all these people see this value and they just come running for what you have, and you start growing really rapidly. But what happens is all the things that used to be easy, managing your company, scaling, keeping up with growth, becomes really hard because you're growing really rapidly. And when that happens, entrepreneurs need to be really focused on basically growth. And they need to go from basically putting their energies against making things work to putting their energies towards simplifying and making things simple so that it can keep up with that growth. And what I find is that if you're distracted doing multiple things, you get totally crushed during that period. And also, it's a really good indication that you actually haven't found product market fit, because every entrepreneur I know who, once they find it, they get that idea really rapidly and they start discarding everything that gets in their way of the one thing that is 10x that is growing like crazy. And
yeah, I mean, the most famous example was Groupon, and the founder had started Groupon inside of another company that was doing like petitions and lobbying, kind of, like these petition website. And then people started using the petition website to petition to get 2-for-1 meals.
Yeah.
He was like, wait a second, there's a restaurant downstairs. Let's see if we can petition them to do this. And it was like, okay, it's a petition. They were like, you know what? Who cares about this petition to get, Buffy the Vampire Slayer back on TV or whatever, or the stupid Comedy Central thing back on. Let's just focus on creating customers through deals. And they created an entire category. And as Andrew, the founder of Groupon, told me, it wasn't even his choice. The entire company didn't want to work on what was slow growth. They all just moved to the side of the ship where all the fish were coming in, and everybody just stuck their fishing rods and went to the other side of the ship to go fishing on the other side. Okay, we'll see you all next time. Bye bye.